This week, what we will be talking about is investments. So the last couple of chapters, I believe it was 13 to 14, we talked about bonds and we talked about stocks. And we've been talking in the context of when companies are looking for investment for themselves. So people are investing in the business, either an ownership interest in it in terms of stock, or are investing money hoping, for payback of principal and interest in terms of bonds. Well, this week, what we're talking about is the fact that sometimes businesses will make various types of investments, either in bonds or in stock of other companies. And so they'll do this either because they want to have an owner go in, maybe with a joint venture with another business, or they have an excess of cash. And so rather than leaving their cash and let it sit in their bank account and maybe make, if they're lucky, 1% interest, they would like to invest their money so that it can work for them, because they're not ready to do anything big with their business yet, but they still want that money to be working and to be growing for them. And so they'd like to make some kind of an investment. So that's what we're going to talk a little bit about this week. We'll distinguish between debt and equity securities and between short-term and long-term investments. Why do companies decide that they would like to make investments? First, companies invest their extra cash into investments in order to earn more income. Like I said, a company may have a large balance in their bank account. Rather than keeping it there, maybe earning, if they're lucky, maybe 1% or so on their money, they would like to invest that so that they can produce a higher income on their money. Second, some entities such as mutual funds and pension funds are set up to produce incomes from investments. And you'll have companies, for example, the Aflac Insurance Company. They collect premiums from their customers for their various accident and cancer policies and illness policies, et cetera, that they sell to people. They have to earn money, and so they will purchase investments with that money so that they can grow that money. So then when somebody has a claim, they can pay out that claim. And so that's how a lot of insurance companies work, okay? Also, companies make investments for strategic reasons, such as investments in competitors, suppliers, and in customers. And so we'll talk some more about that. This chart shows the relative proportion of short-term and long-term investments of 4 different companies. Notice the difference between the investments as a percentage of the total assets between Microsoft and Coca-Cola. Also notice the different emphasis on short-term versus long-term investments for Microsoft and Coca-Cola. So we see that Coca-Cola, the yellow color is the short-term investments, and then the green is long-term investments. And so we see that, for example, for Coca-Cola, we see that they have more long-term type of investments than does Microsoft. Microsoft, they have a lot more short-term investments, and they have more investments in total than Coca-Cola, Starbucks, and Pfizer. Obviously, Microsoft obviously generates a lot of cash through the sales of their various software, and of course now they also sell hardware as well. They sell computers and different things as well, and of course services as well, like Office 365 and all of that. Well, they want to have short-term investments because Microsoft wants to be able to liquidate fairly quickly if there's something that they would like to invest in, like another company. So for example, I don't believe they did, but I know at one point Microsoft was looking at purchasing the LinkedIn company. They want to be able to have that money available, so if they would like to make a strategic investment like that, they are able to do that. Obviously, Coca-Cola, they have their investments in there, which is good. And if they needed to make a strategic thing, then they could, which I know they've bought other companies too, other types of food and beverage companies before. Okay. Same thing with Pfizer, and obviously Pfizer, they need money, to be able to invest and be able to have access to money to be able to invest in, let's say, creating new pharmaceuticals. Or right now, I know Pfizer's one of the ones that we're hearing on the news that has created the COVID-19 vaccine. So obviously they need to be able to have assets that they can, more of a short-term nature, that they can liquidate fairly quickly in order to have the money then to invest in something like that, that would be important for their bottom line and for their growth as a company. Short-term investments, or another name for that, are marketable securities, are investments that management intends to convert to cash within 1 year or the operating cycle, whichever is longer, and that are readily convertible to cash. Again, for example, for Pfizer, if they needed money because they were trying to come up with this COVID-19 vaccine, they maybe would have to liquidate maybe some of their short-term investments in order to come up with the capital to be able to do that, to pay for the development of that. Short-term investments are considered current assets. These investments usually mature between 3 and 12 months. Cash equivalents are not short-term investments because they usually mature within 3 months. So cash equivalents would be like accounts receivable. There's some others as well. So we expect that we would have those within 3 months. So those would not be, cash equivalent would not be considered a short-term investment. Now, long-term investments are securities. In securities are investments that are not readily convertible to cash or not intended to be converted to cash in the short term. Long-term investments also include funds designated for special purchases, such as investments in land or other assets not used in operation. Long-term investments are considered non-current assets. So it could be maybe a bond that matures in a longer time horizon. That could be a long-term investment, as an example. But long-term investments are considered non-current assets. And that'll become important later, the distinction between a current asset and a non-current asset. That's going to become important when you start listing these on your balance sheet under the asset section. That will become important there. So again, debt securities and equity securities. So investments in securities, they can include both bond and well, I just gave you the example, debt and equity securities. So examples of debt securities, they reflect a creditor's relation, such as an investment in notes, bonds, or certificates of deposit. They are issued by governments, companies, and individuals. So you have notes. In fact, even your car note or your house note or your student loans, those can be securitized and can be sold to other third parties. Government bonds, so T-bill, government T-bills, different things. You can also invest in what are called munis or municipal bonds. I know one of the things in my retirement I have a bond fund that is a municipal bond fund. So that's an example of a debt security. You also can have equity securities. And so those reflect the owner's relationship, such as investments in shares of stock issued by companies. And so companies will purchase shares of stock in another company. And of course, you know that we can do that as well as individuals. We can purchase shares of stock in different companies. So classification and reporting. Accounting for investments in securities depends on 3 factors: the security type, either debt or equity, the company's intent to hold the security, either short-term or long-term, and the investor's percentage of ownership in other companies' investees' equity securities. This slide identifies 6 different classes of securities using 3 different characteristics. So the first type are held to maturity securities, represent investments in securities held in another, debt securities held by another company. In the balance sheet, held to maturity investments are shown at amortized cost. And then trading securities include both debt securities that are actively traded and are reported in the balance sheet at fair value. Available for sale securities are those that cannot be classified as held to maturity or trading. Like trading securities, available for sale securities are shown on the balance sheet at fair value rather than at historical cost. And then equity investments with insignificant influence are accounted at fair value. Equity securities with significant influence are accounted using the equity method. And equity investments with controlling influence mean that the company holds more than 50% of the investment company's voting stock. This type of investments are accounted for under consolidation rules. Okay, so debt investments acquisition. So debt investments are recorded at the cost when they were purchased. So let's assume that the Ling Company paid $30,000 on July 1st of 2019 to buy Dell's 7% 2-year bonds payable with a $30,000 par value. The bonds pay interest semi-annually, again, every 6 months on December 31st and June 30th. That would record the purchase as shown there. So you would have a debt investments debit of $30,000, credit to cash for $30,000, and in the note you could say is purchase bonds as debt investment. And so this would be how you could record a company when you're buying bonds in another company. Interest revenue for debt investments is recorded when it's earned. And so obviously the Ling Company purchased bonds in Dell. They're going to receive the interest revenue from Dell, as well as after the bonds are paid, come to maturity, they're going to receive back their principal amount. So on December 31st, 2019, at the end of its accounting period, Ling records the cash receipt of interest as shown above. The $1,050 interest earned on July 1st to December 31st is computed, remember, as the principal multiplied by the annual rate multiplied by the fraction of the year. So in this case, it would be 6/2 of the year, or half of the year. Okay, so Ling's company's financial statements at December 31st, 2019 report the interest revenue and the investment as shown. The financial statement impact is also shown on this slide for the year of 2019. And so we see that we have a debit to cash in the amount of $1,050 because we're receiving cash from Dell. And then we have a credit to interest revenue for $1,050 because we need to record this as revenue, but it's not sales revenue, it is interest revenue from the bonds that we hold. And then we see that on the income statement for 2019, you're going to have a listing of interest revenue in the amount of $1,050. On the balance sheet, under the assets, you're going to have a debt investment listed for $30,000. Now, when the bonds mature, the proceeds, not including the interest entry, are shown above. So you might receive interest at that time, and then you might also then receive back the principal both at the same time. To record each one separately. The cost of the debt security can be either higher or lower than its maturity value. Remember, because these also you could have it sell either at a premium or at a discount. Okay, just like we've discussed previously. Now we assume for simplicity that the cost of the long-term debt security equals its maturity value of all investments. So we're just going to assume that they got their money back. And so you would have a debit to cash in the amount of $30,000 and then a credit to the debt investments for $30,000. You're going to have a debit to cash because again you're receiving cash, and then you're going to have a credit to the debt investments because you now are reversing that because that's now been paid off. Now we'll account for debt securities as trading. Trading securities are debt instruments that a company intends to actively buy and sell for profit. Trading securities are always current assets. The portfolio of trading securities is listed at its fair value. This requires what's called a fair value adjustment from the cost of the portfolio. Remember that a portfolio is a group of securities. Any unrealized gain or loss from the change in the fair value of the portfolio of trading securities is recorded on the income statement. It is unrealized because it hasn't been confirmed by actual sales of the securities. So it would be considered an unrealized gain or loss because we haven't sold the securities yet. It will be realized once we actually sell the securities. TechCom's portfolio of trading securities are held at a cost of $11,500 and a fair value of $13,000 on December 31st of 2019, the first year it held trading securities. The difference between the $11,500 cost and the $13,000 fair value reflects a $1,500 gain. It is an unrealized gain because it has not yet been confirmed by actual sales. The fair value adjustment for trading securities is recorded with an adjusting entry at the end of each period to equal the difference between the portfolio's cost and its fair value. TITCOM records this gain as shown. And so we see that you have a fair value adjustment trading, debit $1,500, and then a unrealized gain income $1,500. And so that is to record the gain. Now, the unrealized gain is reported in the other revenues or gain or expenses and losses section, depending on the income statement. Unrealized gain income or unrealized loss income is a temporary account, remember, that is close to the income summary at the end of each period. Fair market adjustment trading is a permanent account which adjusts the reported value of the trading securities portfolio from its prior period fair value to the current period fair value. The total cost of the trading securities portfolio is maintained in one account, and the fair value adjustment is recorded in a separate account. For example, TECCOM's investment in trading securities is recorded in current assets. This is what happens when we sell trading securities. So when individual trading securities are sold, the difference between the net proceeds, the sell price less the fees, and the cost of the individual trading securities that are sold is recognized as either a gain or a loss. Any prior period fair value adjustment to the portfolio is not used to compute the gain or loss from sale of individual trading securities. This is because the balance in the fair value adjustment account is for the entire portfolio, not individual securities. For example, if TECCOM sold some of its trading securities that had cost $100 for $120 cash on January the 9th of 2020, it would be as shown here. So we would have cash in the amount of 120 because that's the amount that we're receiving in total for selling the securities. And then we would have a credit to the debt investment trading of 100 because that's what they cost us. And then we would have a credit to the gain on sale of debt investments for 20 because that's the amount in gain that we had. Now, a gain is reported in the other revenues and gains section of the income statement, whereas a loss is shown in the other expenses and losses. When a period end fair value adjustment of the portfolio of trading securities is computed, it excludes the cost and fair value of any securities that are sold. Now we will account for debt securities as held to maturity. Held to maturity HTM securities are debt securities a company intends and is able to hold until maturity. They are reported in current assets if their maturity dates are within 1 year or the operating cycle, whichever is longer. HTM securities are reported in long-term assets when the maturity date extends beyond 1 year or the operating cycle, whichever is longer. All HTM securities are recorded at cost when purchased, and interest revenue is recorded when that is earned. The portfolio of HTM securities is usually reported at amortized cost, which is explained in advanced courses. There is no fair value adjustments to the portfolio of HTM securities, neither to the short-term or the long-term portfolios. We will account for debt securities as available for sale. AFS securities are debt investments not classified as trading or held to maturity securities. If the intent is to sell AFS securities within the longer of 1 year or operating cycle, they're classified as short-term investments. Otherwise, they're classified as long-term investments. Companies adjust the cost of the portfolio of AFS securities to reflect changes in fair value. This is done with a fair value adjustment to its total portfolio cost. However, any unrealized gain or loss for the portfolio of AFS securities is not reported on the income statement. Instead, it is reported in the equity section of the balance sheet as part of comprehensive income, according to fair value. Mitsui Company has no prior period investments in available for sale securities other than those purchased in the current period. This slide shows both the cost and fair value of the portfolio of these investments on December 31st of 2019, the end of its reporting period. The year-end adjusting entry to record the fair value of the portfolio investments is also shown. And so you would have a debit for the fair value adjustment available for sale of $1,550, and then you would have a credit for the unrealized gain, but this time it goes to equity for $1,550. And so that is a record the adjustment to fair value of AFS securities. And so we see here that you have original cost. We see here the Apple bonds, the Intex bonds. Then we see here now what the fair value is. So we see that, for example, for the Apple bonds, they cost them $30,000, but they now are only worth $29,050. So they had an unrealized loss of $950. But then the Intex notes, they had an increase of the fair value. So they had an unrealized gain. The difference between those two, total unrealized gain of $1,550. And then that's how, again, as I talked about, how we would record that. And this is an example of a partial balance sheet presentation. It assumes these investments are long-term, but they could also be short-term. It is also common to combine the cost of investments with the balance in the fair value adjustment account and to report the net as a single amount. And so we see here assets, debt, investments, AFS at cost, $73,500. The fair value adjustment for AFS, $1,550. So the debt, investments, AFS at fair value then is $74,550. And in equity is to add the unrealized gain on AFS securities, $1,550. How to report for the next year. Let's extend this illustration and assume that at the end of the next calendar year, December 31st of 2020, Mitsui's portfolio of debt AFS securities has an $81,000 cost and an $82,000 fair value. It records the year-end adjustment of fair value as shown. This year-end adjustment can also be determined using a three-step adjusting process. Step one would be to determine what unadjusted balance equals. And so in this case, we have a $1,550 debit already in the unadjusted, in the fair value adjusted account. Determine what the adjusting balance should equal, which is $1,000 debit in the fair value adjustment column. So that's what it should equal. And right now it has $1,550. So then we record the $550 credit to fair value adjustment AFS and a reduction to the realized gain. So we would have a credit to the fair value adjustment available for sale for $550, and then you'd have a debit to the unrealized gain equity for $550. So again, debit to unrealized gain equity, $550, and then a credit to the fair value adjustment available for sale of $550. Will account for equity securities with insignificant influence. When an investor has insignificant influence over another company, presumably when it owns less than 20% of the voting stock, the company's investment is reported at fair value. Stock investments are classified as either short or long-term based on manager's intent and the stock's marketability. Any cash dividends are recorded as dividend revenue. Equity investments are recorded at cost when acquired, including any commission and brokerage fees paid. The journal entry to record the purchase is shown. And so this is ITI purchases 100 shares of Lynx for $7,000. So you have a stock investments debit for $7,000, credit to cash for $7,000. And so that's to record 100 shares of Lynx. And then this is how we would record dividends. And so ITI receives $10 in dividends on November the 1st from its stock investment. And so it would record the following journal entry. So $10 total in dividends would be received. And so we have a debit to cash in the amount of $10 and a credit to dividend revenue for $10. According to fair value, assume ITI's portfolio of stock investments has a total cost of $7,000 and a fair value of $9,000 on December 31st of 19. The first year it held these securities. The difference between the $7,000 cost and a $9,000 fair value is a $2,000 unrealized gain. Remember, it's unrealized because we haven't sold our Lynx shares yet, so it would be considered unrealized. The fair value adjustment is recorded at the end of each period to equal the difference between the portfolio's cost and its fair value. ITI records its gain as shown. And so you would have a debit to fair value adjustment stock for $2,000 and a credit to unrealized gain income of $2,000. Reporting fair value. The unrealized gain or loss is recorded on the other revenues and gains or expenses and losses, depending upon, again, if it was an increase or a decrease section of the income statement. Unrealized gain or loss income is a temporary account that is closed to income summary at the end of each period. Fair value adjustment stock is a permanent asset account that adjusts the reported value of the stock investment portfolio from its prior period fair value to the current period fair value. The total cost of the portfolio is kept in one account, and the fair value adjustment is kept in a separate account. ITI's stock investment is reported in its assets as shown. When we sell stock investments and we have limited influence. When individual stock investments are sold, the difference between the net proceeds, which would be the sales price minus fees, and the cost of the individual stocks that are sold is recorded as a gain or loss. Any prior period fair value adjustment to the portfolio is not used to compute the gain or loss from the sale of individual stocks. The balance in the fair value adjustment account is for the entire portfolio, not the individual stocks. Assume that on March the 9th of 2020, ITI sold some of its stock investment that had a cost of $500 for $800 in cash. It records what the journal entry shown here. A gain is reported in the other revenues and stocks and gains, other revenues and gains section of the income statement, and a loss was reported on the other expenses and loss. And so we have here cash, debit the amount of 800, because that's the amount that they received was 800. So cash, debit 800, and then credit to stock investments for 500, and then the gain on the sale for 300. That is to report the cost of the shares, which was 500, the amount of increase over what they paid that they received 800, so it was 300. We'll learn how to account for securities that have significant influence. A long-term investment classified as equity securities with significant influence implies that the investor can exert significant influence over the investee. An investor that owns 20% or more, but not more than 50 of a company's voting stock has significant influence over the investee. The equity method of accounting and reporting is used for long-term investments in equity stock that with significant influence. About how to record the acquisition of stock that has a significant influence. Long-term investments in equity securities with significant influence are recorded at cost when acquired. To illustrate, Micron Company records the purchase of 3,000 shares or 30% of Star Company common stock at a total cost of $70,000 on January the 1st of 19 as shown. So you have a debit to equity method investments of $70,000, credit to cash the amount of $70,000, and that's to record the purchase of 3,000 shares of Star stock. Now recording the share of earnings. Now, when the investee reports its earnings, the investor records its share of those earnings in its investment account. Assume that Star reports net income of $20,000 in 2019. Micron records its 30% share of those earnings. The Debit increases Micron's equity in Star. The credit is 30% of Star's net income. Earnings from equity method investments is a temporary account closed to income summary at each period end and is reported on the investor Micron's income statement. If the investee incurs a net loss instead of a net income, the investor records its share of the loss and reduces credits its investment account. And so in this case, 30% of the investee's 20,000 earnings is 6,000. So you have equity method investments debit of 6,000 and then earnings from equity method investments credit of 6,000. And then recording the share of dividends. Now, the receipt of cash are viewed as a conversion of one asset to another. That is, dividends reduce the balance in the investment account. To illustrate, Star declares and pays a total of $10,000 in cash dividends on its common stock. Micron records its 30% share of those dividends received on January the 9th of 2020 as shown. So you have cash in the amount of $3,000 and you have equity method investments credit of $3,000. Reporting investments. The book value of an investment under the equity method equals the cost of the investment plus the investor's share of net income or loss minus its share of dividends. The equity method investment account is not adjusted to fair value. Once Micron records these transactions, its equity method investments account appears as shown. So on January the 1st of 2019, we record the acquisition of $70,000 in value for the shares. Then we have on December the 31st of 2019, we have the share of the earnings of 6,000. And then we have the share of the dividends we credit for 3,000. So then that gives you on January the 9th of 2020, the current balance in equity method investments of 73,000. Now, selling investments of significant influence. When equity method investments are sold, the gain or loss is computed by comparing proceeds from the sale with the book value of the investments on the sale date. If Micron sells all of its Star stock for $80,000 on January the 10th of 2020, it records the entry that's shown. And so we have a debit to cash in the amount of 80,000 because we're receiving cash in the amount of 80,000, and we have a credit to the equity method investments for 73,000. 73 is the book value. We're selling the shares, so now we no longer own those shares, so we're going to zero that out with a credit. And then we have to record also a credit to the gain on sale of stock investments for 7,000 because the book value was 73,000. We received 80, so the difference is 7,000, and that was the gain on the investment. Describe how to report equity securities with a controlling interest. Now, a long-term investment classified as equity securities with controlling influence means that the investor has a controlling influence over the investee. An investor who owns more than 50% of a company's voting stock has control over the investee. This investor can dominate all other shareholders in electing the corporate's board of directors and has control over the investee's management. The consolidation method is used to account for long-term investments in equity securities with controlling influence. The investor reports consolidated financial statements when owning such securities. The controlling investor is called a parent and the investee is called a subsidiary. This slide summarizes the standard accounting of investments in securities. Recall that many investment securities are classified as either short-term or long-term, depending on management's intent or ability to convert them in the future. Understanding that accounting for these investments enables us to draw better conclusions from financial statements in making business decisions. So computing and recording comprehensive income. Comprehensive income is all changes in equity during a period except those from owners' investments and dividends. Specifically, comprehensive income is computed by adding other comprehensive income to or subtracting it from net income. Other comprehensive income includes unrealized gains and losses on available for sale securities, foreign currency translation adjustments, and other adjustments. Accumulated other comprehensive income is the cumulative impact of other comprehensive income. Comprehensive income is reported in financial statements in one of two ways, either on a separate statement of comprehensive income that follows the income statement, or on the lower section of the income statement as a single continuous statement of income and comprehensive income. It will compute and analyze the components of return on total assets. A company's return on total assets, or simply return on assets, or ROA. Remember, we talked about ROA and ROI. I know we've talked about this before. Is important in assessing financial performance. The return on total investments can be separated into two components, the profit margin and the total asset turnover, for additional analysis. This slide shows how these two components determine return on total assets. So profit margin reflects the percent of net income in each dollar of net sales. Total asset turnover reflects a company's ability to produce net sales from total assets. All companies desire a high return on total assets. By considering these two components, we can often discover strengths or weaknesses not revealed by return on total assets alone. This improves our ability to assess further future performance and company strategy. And so we see here that the return on total assets, which is the net income over the average total assets, and that equals the profit margin, and the profit margin equals the net income over the sales. So it's how much profit they have over sales. And then the multiplied by the total asset turnover, which is net sales over the average total assets. So you can figure out for each separate piece of this more, and you can do that and figure out and get a better picture than you could just looking at ROA itself. So it's helpful to be able to calculate the profit margin, the total asset turnover, and ROA, or another way to say ROA is ROI, but look at all three. That's going to give you a better picture than just looking at the return on total assets. Okay, so to illustrate, consider return on total assets and its components for Costco. Costco's return on total assets improved over the 3-year period. This increase is driven by both an increase in profit margin and the total asset turnover. Costco increased its return on total assets during a time when other retailers like Walmart have struggled. To continue this trend, Costco's management must increase net income while keeping total asset turnover steady, or at least at a level where it does not decrease return on total assets.